You might have heard the phrase lazy equity, home equity, equity access, but what is it? Why should you care? And why, as an Australian expat, should you actually give it any thought? Hi there, I'm Jared Brown. If you're new to the channel, thank you for tuning in. I'm an Australian expat financial planner here in Singapore, and in these videos we aim to demystify the world of personal finance. In today's video, we're tackling the topic of home equity. Equity in your property, equity access. What is it? Why should you think about it? And what can you do with it? So let's start with the basics and look at what is equity in your own home. Now, the equity in your home refers to the difference between the value of the property and the value of the mortgage. So if I own a property that's worth $2 million and I have a mortgage that is $800,000, my equity is $1.2 million. $2 million, take off the mortgage of $800,000, I'm left with 1.2. So that is the equity, that is the value that I own in that property based on the value, based on the mortgage. We then have available equity, and that refers to how much the bank is willing to lend me. Now, most banks in Australia will cap that loan to value ratio, that is the size of the mortgage relative to the value of the property, at 80%. So, if my property is worth $2 million, 80% of $2 million is 1.6. Now, if I already have a mortgage of $800,000, that means there's another $800,000 left of accessible equity. Of course, the bank needs to ensure you can repay it and check your income, check your expenses, etc. But the available equity refers to the amount the bank is willing to give you relative to the value of the property. So now that we have an idea of what it is, what can we do with it, what should we think about doing with it, and why? Let's dive in. So on that available equity, and we'll use that same example, I have a $2 million home, $800,000 current mortgage, and I'm going to borrow another $800,000 to take me up to that 80% limit. So here are the 4 things that I can do with that money. I should say 4 worthwhile things to consider. We'll ignore the fact that you could take that money and go and piss it up against the wall, because that is not a sensible thing to do. Number 1 is you could set up that equity access loan and use that as your emergency fund or your buffer or your what if something goes wrong fund, a little bit like the emergency fund. But you might use it as the treasury function for your property portfolio. So for example, you could have that $800,000 facility set up and remain undrawn. You don't pay any interest because it's undrawn, and you would only pay interest when you start drawing money from it. But it's there, it's available, and should you need it in future, you know that you can tap into those funds. Number 2 is you could take that money and use it for renovations. Now, this might be the case if you're moving back to Australia, you need to add a bedroom, add a bathroom, renovate the kitchen, extend the property, whatever it may be. You can tap into that equity to then go and add on those renovations. Now, if they are significant renovations, then they're going to upgrade the value of the property. You could also seek to have those plans reviewed by the bank and increase the value in their eyes and potentially borrow more. So for example, you might submit those plans to the bank. The bank might carry out that valuation and say, right, well, instead of $2 million, based on the finished renovations, we believe it'll be worth 3. So we'll give you 80% of the 3 million, which would be 2.4 rather than the 1.6. So don't ignore that as an option. You can use that for renovations, and of course that could be done whether you plan to move into the property or you plan to keep it as an investment. Number 3 is you could use those funds to go and buy a portfolio of shares. Now again, you only pay interest on the money that you actually utilize, so you might not use the full 800. You might take 100 out of that and go and put that in shares or ETFs or a managed fund or whatever it may be. As an Australian expat, that's usually not going to be tax deductible, because we're not using those funds to produce a taxable income in Australia. But we could use those to buy shares or buy ETFs or buy managed funds or whatever it may be. And number 4, which is the tax deductible option as an Australian expat, is we could use those funds to go and buy another investment property. So whether it's commercial or residential property somewhere in Australia that we plan to rent out, we could take some of that 800 or the full 800, utilise that money as our deposit for the new property, set up a new loan secured by that new property, and not have to contribute a single cent, providing the bank's willing to lend us enough, of course. So for example, we might want to buy $1 million home. So of that 800,000, we're going to take out 250. That's going to cover our 20% deposit, $50,000 worth of purchase costs, stamp duty, conveyancing, etc. And the other 750 or 800,000 is going to be secured by the new property. So there you have it. There are the 4 options when it comes to accessing equity, why we might want to think about it, and how we can put that lazy equity to work. If you have any questions at all, drop me a note in the comments, but thank you for tuning in. Do remember to like, subscribe to the channel. I look forward to seeing you in the next one.